so that so that you guys can ask questions. So we'll take about an extra 20 or 30 minutes, and we'll have an actual Q&A session at the end. So as we're going through the entire lecture, let's please hold questions. There may be certain instances where I'll stop and see if there's something in the chat or if somebody has a particular question. However, without further ado, let's get right into it. All right. So starting out, what we'll do is we'll just look at base principles. But I want to give you guys, excuse the typo at the bottom. I want to give you guys a quick overview of the importance of today's lesson, right? And why we're even covering this, right? So this is lecture one, right, which is the paradigm shift into seeing price from the stance of logic and delivery. All right. So many times as traders, we only see candles and patterns. Okay, but you have to understand that even a candle in itself, right, there's delivery within this, right? You have to look at that and see delivery, not just the candle. Okay, and that's the whole basis of this very first lecture. Okay, all right. So the contents of this lecture, right? We'll go into obviously base principles, high probability pricing sequences. We'll talk about fair value and what that is, the actual chain and state of delivery. Okay, this will be progressive throughout the entire mentorship, but I'll give you guys a brief indication of what that is, and it's not anything super complex. Um, we'll go into the market efficiency cycle, right? Understanding balanced price ranges. Just a quick introduction to institutional order flow. We'll save that in-depth piece for lecture 3 because it ties into market maker buy and sell programs, right? And then you guys will see how all of this stuff, right? The understandings of all of this stuff ties into why the anatomy of a dealing range and why I always say this fractal, right? The entire market points back to that one fractal. Okay, and I can guarantee by the end of this mentorship, you guys will see exactly what I mean. All right. Cool. All right. So why this lesson? All right. Once again, it's just aimed at shifting the trader's paradigm away from only seeing candles and patterns to viewing and understanding price through the lens of mere logic and delivery. Right. This lesson is foundational to all future understandings. All right. Soon the trader will realize that the entire market points back to that one fractal. All right. So base principles, obviously, these are things that you guys may already know, right? So just liquidity signatures, interpreting price from a delivery angle through intellect, the Peter matrix, simplified, and so on and so forth. So in terms of liquidity, right? We all understand that we have buy stops, sell stops. Let me bring this tool up. All right, here we go. All right, all right. So just for simple terms, all right. Obviously, we have buy side liquidity above market price. We have sell side liquidity below market price. All right, pretty simple. All right. In addition to that, we have to understand certain signatures, right? In terms of a high resistance signature, right? And then we also have a low resistance signature. So when we're talking about high and low resistant liquidity runs, right? This is something that we're gonna focus heavily on, and we're gonna gain a proficient understanding throughout the rest of this mentorship in terms of that. Okay. So remember, this is all just base principles. Okay. Going back to here. All right. Now, if you guys were to ask me, if you were to say, hey, Chris, how would you interpret um, the market, right? And this is going back to what I was saying earlier in terms of just interpreting the market from the stance of intellect. All right. I'd say, hey, price is only moving from buy stops to sell stops, right? In the midst of doing so, it creates imbalances, and then it aims at rebalancing those imbalances. All right. That is what creates structure. That is what creates a high probability pricing sequence. When I say everything points back to this fractal, all right, you'll see how it points right back to that same fractal. All right, but this is just understanding the fractal from just mere intellect, right? So when we're saying price is moving from sell stops to buy stops, right? In the midst of doing that, you guys can see the displacement here, right? And then now the market aims at rebalancing that range, and then that cycle starts over again. What you should also see in this image, all right, is if you look here, the same fractal plays out again, right? Price goes to sell stops, buy stops, right? There's your displacement within there, and it rebalances that range, and we continue again. All right, so the same fractal continuously prints throughout this market. All right, and if you feel like I'm flying through this part, this is because this is all just base stuff. This is basic stuff. All right, so price delivery, right? Just understanding the phases of price delivery. Okay, there's consolidation, expansion, reversal, retracement. All right, so if you go back, you look at ICT's price delivery cycle. All right, this is how he provides it to us in terms of interpreting price. All right, I'm going to give you what I think is a much better way of understanding price. But just understanding when you look at a market, you have to profile that market. All right, and then in that profiling, once again, that becomes fractal within itself. Okay, so once again, it's only going to be either a consolidation. Everything literally starts at a consolidation, right? Because price is accumulating. All right, then we get that expansion. All right, we have that expansion. There we go here, right? Then we go reversal, potential retracements, right? And then price goes back into a reversal phase. That same fractal, right, plays out right down here as well. Consolidation, expansion, reversal, retracement, right, back into a reversal again. All right. All right, so the way I like to interpret this, all right, is this here. All right, so the market will engineer, neutralize, distribute, rebalance, and redistribute. Okay, just to give you a visual of what that looks like. Let me just stick to this screen here. All right, so we're saying engineer, right? So this is where price is creating those short-term highs. Neutralize, created short-term highs, and then we take out that liquidity. Right, this is why I always say, you guys will always hear me say, hey, never take the very first swing into an array. All right. And you can't be robotic when I say that, but you guys will understand certain frameworks too, and how to actually engage with that. But price will engineer, it neutralizes. After neutralizing, typically that's tapping into an array, right? We go through a phase of distribution. We engineer, we neutralize, we distribute. All right. After the distribution, you have to understand there's going to be some form of displacement within this portion of price. All right. Because of that, price will need to rebalance. We engineer, we neutralize, we distribute, right? Creating that inefficiency. Going back to what I stated earlier. Hey, the market moves from buy stops to sell stops. In the midst of doing so, it creates imbalances and then it rebalances that range. All right, trading to a point of fair valuation. Okay. Once the range is rebalanced, everything is traded efficiently, right? Now we go back through a phase of redistribution. All right. What you notice is that same fractal will play out here, okay, which is the end goal of this entire lecture. All right. So another understanding in terms of price, right? We have to understand that price is trading from fair value to discount, discount to premium, premium back into fair value. All right, just keep that in mind. All right. We'll go back and we'll come back to this and you'll see what we mean in terms of that. All right, but just giving you examples right here. Here's price engineering stops. Okay. Liquidate those stops. We neutralize. This is that phase of distribution, taking out sell stops at the bottom end of the range, right? There's an inefficiency. We trade back up into that inefficiency, right? And then we go back through that same fractal again. If you look here, just right in here, that same fractal plays out once more. All right. Price is literally doing the same exact thing every single time, right? We engineer, we neutralize, we distribute. You notice there's a slight imbalance in there. Once we distribute, we rebalance, right? And it goes back again. Once more, the same fractal is here, right? Engineering liquidity, neutralizing, distribution. You can see we run out sell stops here. Inefficiency is right there, right? Same fractal plays out over and over and over again. This is actually, this bottom piece down here is actually from, this is delivery from last week, I believe, right? But same idea. Engineering here, neutralize, distribute, right? And then we trade back to the range. We rebalance a part of the range, all right? And then we get away. Notice I'm not showing you guys time frames here, right? Because time frame does not matter, all right? That understanding of engineer, neutralize, distribute, rebalance, redistribute, that understanding is literally, you can see that within every discipline within this entire market, all right? All right, so now the PD array matrix, all right? So obviously there are multiple arrays, okay? However, what you guys will find is that the imbalance or the inefficiency is the single most important array in price, all right? So almost every other array heightens in probability when it's accompanied by an imbalance, all right? So we have the old high, the order block, and the fair value gap, all right? These are when I'm looking at price, all right, these are what I consider. Okay, everything else is, in my opinion, just an overlapping piece. All right, most of the times when you have a mitigation block, right, or a breaker, it's accompanied by a fair value gap, which heightens the probability. All right, and if you have a breaker and a fair value gap, right, then you're probably not going to make it up into that order block. Okay. And then what you guys will learn is that because the imbalance is so superior, it allows us to see it as a market structural shift. All right. Should price show zero concern for its existence? And we're going to go into what that means. All right. So once again, when arrays coexist, we refer to this as overlapping arrays. All right. Now, although the PD array matrix is important, we have to remember that the array by itself only provides potential. Okay. So we're never just looking at an array and saying, oh, there's a fair value gap. When price trades back up into that fair value gap, I'm going to place a limit order entry and pray that price goes short. No, right? The advancement and the reason that you guys are here is because we're moving from this space of being a novice trader and trading a key level, right, to moving over to mastery, right? Which I think is learning to trade the response at the key level, right? Truly understanding the change in state of delivery, all right? Understanding that when price makes it back up into this array, so let's say we have that engineer, we neutralize, right? We distribute, right? Obviously, there's going to be an up close candle here, creating your order block. We distribute, all right? Although there's a fair value gap right here, when price runs back up into this area, right? Now our minds say, hey, that fair value gap is just potential. All right. So how many times have you placed a limit order entry here and then boom, right? And you're not understanding why. All right. So once price makes it up into that array, our minds should transition into high probability pricing sequence. All right. That fractal that I'm telling you guys, that point from our entry model to the entire market, it points back to that same fractal of engineer, neutralize, distribute, rebalance. right? Redistribute. So when price is rallying back up here, all right, on a fractal level, you're going to see that engineer, neutralize, right? Rebalance, redistribute. Then you don't have to have a market structural shift or what most view as a market structural shift. It points back to the imbalance, right? Because obviously within this little portion of price, right in here, there's going to be an inefficiency, right? Price negates that inefficiency, right? We see that as a market structural shift, right? Then we throw in there order flow and things of that sort. Okay. Now, when it comes to the imbalance and price trading through an imbalance, all right. So let's say we have here, try a different color. Let's say we have candle here, candle here, candle here, right? Obviously, there's an imbalance, and price trades down, and we close that imbalance, right? We see that as a market structural shift. All right. We don't have to wait on the structural points down here. That becomes your market structural shift. Now, it is not just because the significance is not just that price trades through that inefficiency, right? It's why and when does that happen? Why and when does this type of behavior happen? Right? It's happening after trading up into a higher time frame PDA rate. Now we're seeing a difference in the state of order flow, right? The reason being is because if you think about it, price goes from this point A to point B, right? Obviously, the price action here means that discount arrays are being respected, right? What is this inefficiency, right? When price makes it up here, that inefficiency is a discount array, right? However, if you think back to, I guess it's Newton's laws of physics or motion, right? An object will move in one direction until, met with a much higher, stronger force. Then it has the potential to be stopped or change direction. Right? That higher time frame PDA rate is a much higher, stronger force. Right? Now the market is saying, hey, made a higher time frame PDA rate. I no longer care about the imbalance. Okay, which brings us down to here. All right, so we kind of talked about what that looks like. Now let's talk about fair value. Okay, so fair value can be considered as a point in the market where price clears an old high or low and not enough trading is done at that particular area. All right. So markets will seek to offer fair value at these areas to allow participants to trade at these points in price. Okay. So once it reaches or offers fair value, its job is done and we expect it to reprice to new areas of liquidity. All right. So what that means is, let's just go down here. All right. So fair value. Let's say we're looking at our market and we have something like this. Okay. And this is that low. When we see speed through that low, all right, this point here becomes an area of fair value, right? Fair valuation can be found at that point. This market wants to trade efficiently. Okay. So beyond this point from here to here, there's only sell side offer, right? And there's so much speed through that area to certain market participants, not me and you, right? The market is going to want to offer fair pricing to those individuals. All right. Once that market trades back higher and reaches a point of fair valuation, right? Then we will see it seek lower levels of liquidity. All right. So this is why earlier when I'm saying, hey, the market trades discount to fair value to premium, so on and so forth. Right. What you should be hearing when I'm saying that. So let's say if I'm saying discount to fair value, and then fair value back to discount or some sort. All right. What's key about me saying this is that within here, that means something is taking place, right? What's taking place? What's taking place is the change in state of delivery, right? right? So we go discount, fair value, back to discount, all right? Change in state, all right? So let's look at a few examples of fair value, and then we'll move into talking about the change in state. So if you guys look here, we have this high, price rallies lower, and boom, we displace through that level, all right? Price will want to seek that point of fair valuation, right? And then we'll go back into seeking levels of buy side liquidity. All right, look over here. Market rallies higher. We displace. We seek a point of fair valuation. All right. Once more, price higher. We displace. Right. We seek this point of fair valuation. All right. It's at that point where buy side is offered into the marketplace. We displace. And beyond that, there's nothing offered but sell side, at least until this point. All right, next example. Same idea, right? We displace through that point back to an area of fair value. Okay. We're going to come back and talk about this image right here. All right, but same ideas. We displace, come back to an area of fair value. All right, now, one key note, all right, for you guys to remember is that order blocks, right? So when I'm talking about the change in state, we have to remember that the change in state equals the order block itself. All right, so order blocks form in areas of fair value. You should be taking note on that. Right? And the reason we say that is because, right, this market is trading from fair value to discount, right? Discount to premium, premium to fair value. Well, how does it go from fair value to discount? It has to change states of delivery, right? What is the change in state? The change in state is the order block. Okay. Now, the whole basis of this mentorship is so that you guys move away from looking for order blocks. All right. And instead of looking for order blocks, we understand one, where order blocks form. Okay. And then two, right, the delivery that creates the order block, or the delivery that creates the change in state. All right. So what that means is when you're looking at price, and let's say this is a structural point here. All right. And price moves higher, and then it trades away. All right. The traditional way of looking at price action is to, or what's all over the internet, is to see this candle, right? And now we're saying, oh, that's the order block, right? We see an up close candle. We see a downward push. All right. And then we say, hey, that's the order block, right? We see a little bit of displacement through this area, right? Market structural shift. And now we're wanting to trade. Now we're wanting to trade back into this area, or potentially even place a limit order entry at that order block, or we're thinking that that order block is going to hold. What we're not realizing is at this structure point, there's sell side liquidity, right? Price is already, in part, already done its job, all right, depending on how we leave this range. Okay, so what you guys are going to learn within this mentorship is how to enter and engage as the OB is being created. All right, so at this point, around this point, somewhere within this candle, all right, there's a certain delivery, all right, that is prompting us to enter. All right, and it's a certain sequence in terms of that delivery. Okay, and that comes by way of understanding, once again, one, where order blocks form, and then two, how they actually form. All right. So the change in state. All right. The change in state, once again, is the order block. A lot of people, this is, I guess, become like a popular thing, and everybody's talking about the change in state, right? This is nothing new. Okay. It's just maybe the understanding has just not been presented correctly. All right. But the change in state is the order block. All right, so an order block is a change in state of delivery in the market, and it's not about the candle itself, but rather the shift in the market's behavior from buy side to sell side or vice versa. This change occurs when the opening price of a candle, right? Opening price of a candle is violated, indicating a shift in the market's direction and focus on either buy side or sell side liquidity. All right. So this is ICT's explanation of that. All right. But for development purposes, I want you guys to focus on the low of this candle. All right. When price trades through the low of that candle, all right, that is our change in state. All right. Right here, price trades through the high of that candle, right? That changes the state of delivery. All right. And just trust me when I say this. All right. Just focus on the actual low point and the actual high. Okay. Because if you try to focus on the opening price of the candle right now, it will fail you. All right. Change in state, once again, is once price trades through the higher low of that candle, right? It changes its state of delivery, right? That creates the order block in that very moment. Okay. So you're not looking for a trade back to an order block. You're looking for the moment that order block is actually created. There's a difference in how you engage. Okay. All right. Market efficiency cycle. All right. So a simple understanding of price is that price will trade stops to inefficiency or inefficiency to stops. Okay. This is primarily the case for a trending or an expanding market. Right. So if you guys look here, we're trading down stops to inefficiency, stops to inefficiency, stops to inefficiency. And then we run into stops. I mean, we run into a higher time frame array, right? But obviously, we trade through stops right here. Okay. Now, once price reaches that higher time frame array, right, which we know provides only potential. Okay, because the order flow at this moment is saying that, hey, I'm respecting premium arrays, right? These fair value gaps are being respected. All we know as a trader is that we traded into a higher time frame array, and that array provides potential. There's not a single person on this call that can say, yeah, it's gonna turn around. No, because price could just very well do that, right, and trade through that higher time frame array. All right. So basically, if you took a trade, you basically just exposed your portfolio while the market was literally telling you that order flow is bearish, right? Premium arrays are being respected. Okay. So moving lower, all right, what you'll find is that once price reaches a higher time frame array, right? Remember that array only provides potential. We have the chance of seeing a change in price's behavior. All right. Now, in a reversing market, price will begin to negate imbalances, trading stops to stops. All right. This is the first sign of a market structural shift. Okay. So when we say market structural shift, we're not necessarily referring to this point in price, right? Just that's traditional market. We're not referring to that. Market structural shift is it's a holistic understanding, right? It means that price has met an area that provides potential, and I'm seeing a change in behavior. All right, that's what market structural shift means for us. All right, and you guys, right? When I say us, I'm speaking about IPDAX, right? Which are you guys. All right. So once again, reversing markets, price will trade stops to stops. Okay. Now, before we even reach stops, right? Obviously, prices created these sell side imbalances or SIBIs. All right. So we have sell side imbalance. We make it into the higher time frame array, right? And then if you look at this candle, right, and trading back up into this inefficiency, price has the opportunity to reject from that imbalance and then go here. All right. However, we're thinking about cause and effect. We're thinking about the response. Okay. When price reaches that higher time frame array, right, it trades here and it closes through that inefficiency. All right. So if price is trading, you guys have to excuse the transition back to this. I don't know why it's pausing so much. All right. So if price is trading stops to imbalance, all right, and we know that this is a constant cycle. We're trading stops to imbalance, and this is a constant cycle. And price makes it into a higher time frame array, right? So stops to imbalance, stops to imbalance, stops to imbalance, right? And we make it to that higher time frame array, which is here. And obviously we're going to have arrays right here, or these inefficiencies. And we trade up and we close through that imbalance, right? The market at this moment is basically telling us, hey, I could care less about the imbalance, right? If that be the case, then stops come on the menu. All right. So clearing out imbalances after tapping into a higher time frame array, right? That's an indication of an opposing stop run, right? When I say opposing stop run, that means the stops at the opposite end of the range. All right, just remember that term. You'll hear that term thrown around every now and then, right? So that means that there's a potential for an opposing stop run. Okay. So if we look down here, you guys can see, right? And this is an older image from this year, but you guys can just see right here, right? We're going stops, inefficiency, stops, inefficiency, right? If you think about what you're seeing in price action now, this is, I believe, a monthly chart, right? Think about where we're potentially headed as we push into 2024, right? If we stick by this current cycle of price stops to imbalance, stops to imbalance, this idea is fractal, right? So we just met imbalance. We may be trading down to stops, right? And this is from a monthly perspective, right? Okay, you guys can see here, right? We're going stops to inefficiency, stops down into inefficiency, and then we're seeking stops again. All right. Right here, we go stops, inefficiency, stops to inefficiency, right? And obviously price gets down here and it must have reached into some type of higher time frame array. All right. But the very first thing that you guys should notice is before price actually turns around, all right, look at this point. See what happens to that inefficiency? All right. So we go stops here. And then we would expect or anticipate for price to go inefficiency, right? Back to stops. What is price telling us? All right. We're seeing price negate those imbalances. That's the very first sign, right? We negate the imbalance. We trade a little lower right into the rejection blocks. And then you can even see this inefficiency here. Same idea. All right. This is an indication of an opposing stop run. And then you can also see right here, price returns back to an area of what? An area of fair value in order block forms, right? Order block forms in area of fair value because price is trading from, right? We're going from an area of discount, premium to fair value, right? And then fair value back to premium, all right? Order blocks form in areas of fair value, all right? If you look at this point right here, trading through the high of that candle, right? We take out liquidity and trading through the high of that candle. That is your change in state of delivery. All right. If you look at price action right here, right? At some point when this candle was being created, right? Price trades here. That wick is price mitigating that order block. All right. So it's happening in that very moment. Another good example here, right? So if you notice, price was going stops. We took out stops. We traded back up to inefficiency. And then we trade lower, right, through stops. Now, if prices continue to be bearish, we should go inefficiency back to stops. All right. But if you look here, Very first sign is we trade up, we negate the inefficiency, right? That is a market structural shift for us. We negate that imbalance. I'm sure most of you probably saw that mini series. All right. So look at this portion right here. You see that candle? All right. That candle took out stops, right? There's order pairing from that candle. We had a change in state of delivery from that candle. We had a little bit of displacement. However, price runs back lower and manipulates that particular candle, right? And just put all the pieces together right here. We run out stops. We trade through an imbalance. All right. And now we're back above the opening price of this candle where a previous change in state of delivery was. All right. So we go back into that candle. All right. After this market structural shift. And then look at what happens as a response to this candle. As a response to that, price creates what? Another change in the state of delivery. Right? At this very moment, you can be bullish, literally right here. Not needing price to trade above here. By the time price does this, you're late. All right. At this very moment, you're bullish, right? You're buying actually, right? And we're targeting buy side liquidity. Okay. So now let's talk about balanced price ranges. All right, or balanced or efficiently traded price ranges. Okay. And this is important, I promise you. All right. A balanced or efficiently traded price range, right, is when price spends a great deal of time offering both buy side and sell side to the market within a specific range, right? So let's say we're here, right, and we're basically spending a lot of time within this portion of price, all right, or we've offered buy side and sell side. I don't want to say time because it doesn't mean like, hey, how much time? It's just that we've offered buy and sell side multiple times, okay? In that case, right, we can consider that range is efficiently traded. All right. Now, the way we engage or use this understanding is by looking at how price actually exits a balanced price range. Right. So when it leaves the range, technically, that's when we say, hey, that's a BPR, it's a balanced price range. All right. But the importance is looking at how price actually exits that range. All right. Something else that I should bring your attention to, we'll come back up to this part. All right. So when we have this portion of price here, okay, you can see there's delivery within this range of price. All right. A range of price can have an untouched imbalance and still be considered a balanced price range. Why? Because we've offered buy side and sell side evenly throughout this entire portion of price. All right. So when I look at price, I'm seeing this whole piece of price, right, as a range or balanced price range or an efficiently traded price range. All right. So over here, this range of price would be considered efficiently traded, right? This range of price, if you look here, there's displacement, right? And then we have this big gap. Okay, so one very good way to understand this is by looking at each piece of delivery, right? See this part of delivery as a down close candle. See this part of delivery as an up close candle. Down close candle. Up close candle. And then obviously we have down close candle here. Right, we can see that as an up close candle. There are no voided points in price. All right, meaning that everything is offered efficiently. All right, now if you look over here and we take that same approach in terms of down close candle, up close candle, right? Here we are. Just consider this delivery as a down close candle. Consider that as an up close candle. Down close candle, right? We can even bring it down to that point. And then just consider that delivery as an up close candle, right? And looking at this, right, there's a voided point in price. Okay, meaning that this range is not necessarily efficiently traded, right? We may see price seek an area of fair value, right, back into this range. Okay, now going back to what was mentioned about looking at a balanced price range and studying how price actually leaves that range. Okay, so when you're looking at price, all right, and let's say price is basically offered buy and sell side through this little range here. All right, so we're seeing buy and sell side offer. We spent a lot of time in here. When you see this, what you should say to yourself is, when price leaves this range, that's sort of like price kind of choosing its fate, right? Because this market wants to deliver and offer price efficiently. That's its main job, right? Once price is efficient, we run to liquidity. Once we run to liquidity, right, we seek to deliver price efficiently. That's why I say, hey, price trade stops to inefficiency, stops to inefficiency, stops to inefficiency. Okay. So when a range is delivered efficiently and we leave that range, right, that is like price choosing its fate, right? Why am I saying that? The reason I'm saying that is because once price leaves that range, right, should it return back to that range? If we leave this range and we go bearish, right? Should price need to return back deeply into that range? No. Why? Because that range is already efficiently traded. All right. Now, if it does return back inside of that range or deeply inside of that range and we start seeing closures of some sort, that tells us a different story. All right. And I'll give you guys an illustration of that once we go back to the whiteboard. All right. But just look here. All right. So once again, what's more important is our understanding of the way we engage with how price exits a balanced price range. Okay. So either rejection blocks will form, indicating an opposing stop run. I'm just going to show you an example of Euro USD. All right. Or we exit the range with speed. All right. Leaving behind areas of fair value, imbalances, and body closures. Okay. So what that looks like, if we leave this range with speed, right? That's a complete difference than this. All right. Leaving behind areas of fair value. Price will want to return to areas of fair value. And our minds should say, hey, what forms in areas of fair value? We talked about it earlier. Order blocks, right? Order blocks form in areas of fair value. Okay. So just to give you guys there's an example, pretty good example of this last week on Euro USD. Let's go here. I want to say this was on Thursday if you look at a 15-minute chart. Right here. So, all right, cool. So if you guys take this portion of price, all right, I'm looking at this portion of price. And I'm saying, hey, I want to see how price leaves this range because this range is efficiently traded, right? We spend a lot of time within this range. So when price exits this range, right? If we exit this range with speed, all right, there we should only come to a point of fair market value. All right, so balanced price range, we exit that range with speed, right? At most, we'd only anticipate that market will come back to fair market value, right? And one key note, order blocks that are formed around fair market value, right? As price is building equilibrium, order blocks are formed at fair market value, right? They are likely to hold. Okay. Now, that doesn't mean that idea can't fail. All right. And if it does, it probably means you're in a situation where it's probably a seek and destroy profile like we had on this particular day. All right. So what I was looking at on this day is I'm looking at price action and I'm watching price run through this part of the range because from the whole parent price swing, we were in the parent price swing was bearish. So just imagine that price is up here and now we're getting this range like this, right? We go here and I'm looking at this little portion of price that I have highlighted on the chart right now. And I'm saying I want to see how price exits this part of the range, right? Because technically we're inside of an overall, consolidation or efficiently traded price range. But I'm saying, hey, I want to see how price leaves this portion, all right? So we trade lower, right? And rejection blocks form, right? Now, how most people would see this as, hey, we took out liquidity, we had a market structural shift, I'm going to trade that fair value gap, right? And that idea is it's not completely wrong, but it lacks understanding, all right? Because if price is truly exiting this range, we see it exit that range with speed. And then we understand that order blocks will form at areas of fair value. So even if I didn't catch this point, once it returns to an area of fair value, there's a certain fractal in price that I'm looking for within this inefficiency. All right. And if you guys have questions in terms of that, I promise you we'll come back to them by the end of this lecture. All right. So here's a few examples right here. All right. So if you look at this portion of price, right, so let's take this point. All right. So I'm looking at this portion of price, right? We've left the range, all right, but obviously that range is not efficiently traded. So we trade back up to a point of fair valuation. All right, order block forms, and then we exit again. Going to this point, right? You can see that this range, all of this, right, there's tons of delivery within this range, right? We go buy side, sell side, buy side, sell side, buy side, sell side, right? So at most, once price leaves this range, we've left that range with speed. At most, I only expect price to come to an area of fair market value, right? At most, fair market value. I can excuse the line for some reason it won't draw the scale, but at most, fair market value. All right. If you look at let's go back to Euro USD on the week of FOMC right here, 4-hour chart. All right. So look at this price range. Right. Everything here is efficiently traded, right? Price spends a great deal of time within this range, all right? It's offering buy side and sell side multiple times. We leave that range with speed. Boom, we left with speed, all right? A second ago, I told you order blocks formed, right? At fair market value or the equilibrium portion of the range, those order blocks tend to hold, all right? So even with FOMC, right, you're seeing that news follows price, right? Price, whatever theory or concept we're speaking about in terms of price, it stands. All right. Price trades right to fair market value, and then we drop off. All right. So that's how you want to engage with your understanding of balanced price ranges or efficiently traded price ranges. Okay. Going back to here. All right. All right. So really quick, in terms of institutional order flow. All right. Just really quick, we'll come back to this part of the lecture once we get into lecture 3. But basically, there's a buy side of the curve, and then there's also a sell side of the curve. All right, just remember that. Always see price from this stance. Okay, buy side of the curve, sell side of the curve. All right, when we're on the buy side of the curve. All right, now actually let me draw this here because that's backwards. When we're on the buy side of the curve, all right, down closed candles will support the direction of price. Does not matter what time frame you're on, right? So once again, down closed candles, right? And also discount arrays. So whenever you look at price, regardless of time frame, and you understand, hey, you understand where price is pushing to, right? It's pushing to a premium array. All right. Always ask yourself at this very moment in time, not what I anticipate or what I expect. At this very moment, are discount arrays or premium arrays being respected, right? Are down close candles or up close candles being respected, right? Find some type of alignment with those two questions, all right? And if you're in a situation where you say, hey, discount array, I'm at a higher time frame array, premium array. However, for the moment, discount arrays are being respected on this lower time frame. Down close candles are being respected on this lower time frame. If you say that, right, and if you have two things that contradict, there's no reason for you to expose your portfolio to that. Why? Because at some point in time, if this market is turning around, you will be able to say discount arrays are being taken out, down close counters are being taken out, even on the most fractal level, right? Because you have to understand that before you get to that higher time frame, right, things will happen on a smaller time frame. You don't get to this 4 hour time frame until things start happening on that 1 minute time frame, right? At 5 minutes, at 1 hour, right? So on and so forth. Then obviously, when we're speaking about the sell side of a curve, right, just the opposite, up close candles will support the direction of price, right? So same idea, premium arrays, right? Up close candles and premium arrays, right? These guys will support the direction of price, right? So even if price trades down into this discount array, it's a higher time frame discount array, right? There is no way that I'm going to buy until I can say, hey, I'm now seeing premium arrays taken out, whether there's an imbalance right here or what. And then I'm seeing discount arrays. Obviously, there's going to be a down close candle that has to create that low. Discount arrays supporting price, right? Creating a change in state, right? That candle causes a new change in state. That tells me that that candle right there, right? Or that candle, which is a discount array, it's price is telling me, right? Visually, that discount arrays are now respecting price. I don't need a market structural shift, right? I just need to understand order flow. And I need to understand when I'm supposed to apply this type of stuff, right? This is framework and context, right? Coming into alignment. All right, that's institutional order flow. Now, the whole basis of this lesson, right? Everything that we just discussed is to bring you into understanding the anatomy of a dealing range, right? And a dealing range is a suite of both buy side and sell side liquidity, right? Followed by displacement. Okay. So dealing range. All right, a sweep of buy side liquidity and sell side liquidity. All right, followed by displacement or speed. Okay. So to give you guys a scenario, right? Let's say we have a market where we're here. Obviously, this is a low. We displace beyond that low. Okay. And right here, we have that inefficiency. All right. So going back to what we discussed earlier, all right, price needs to engineer, neutralize, distribute, rebalance, and redistribute. Okay. So in looking at this fractal from a zoomed out perspective, we've engineered, we engineer here, right? We neutralize here. We distribute with this entire range. All right. So our minds think, hey, price needs to rebalance that range. All right. And it needs to redistribute. So everything we talked about up until this point, you can apply every single concept or theory to what I'm looking at now. All right. If you were seeing this delivery here as one whole down close candle, this delivery here as one whole up close candle. All right. And then this delivery here as an up close, there's some type of void, right, within price that needs to be filled, right? Price needs to rebalance that range. All right. There's also that sense of price is engineered, it's neutralized, it's distributed, right? Now we need to rebalance and redistribute. There's also a sense of price, right? It went here through buy side liquidity. Obviously, there would have been some type of displacement either here or here. And if we're saying, hey, price trade stops to inefficiency, it traded through stops. However, it said screw the inefficiency and it ran through stops, right? So reversal. Earlier, we also talked about price delivery cycle, consolidation, expansion, reversal. Now we're probably going to get retracement, right, back through to reversal. All right. So there's also PD array matrix within this as well. All right. So here's price, right? And we're crouching below a discount array. Premium array. Okay. So we've just taken out stops, sell side liquidity here. And our thought process says, hey, price needs to trade into inefficiency, from inefficiency back to stops. All right. So we're keying on this level. Now, are we going to take a blind trade from that level? No. That level only provides potential. All right. We'll come back to that. By the end of the lesson, you'll see how everything will tie back into that. All right. So price rallies up here. We tap into that inefficiency. And then we displace. All right. At this very moment, we have a dealing range. All right. Think for a second. Everything within this piece of price was efficiently traded, right? Price left that range with speed. At most, it should only trade back to this range, right? If it continues to be bullish, it should only trade back to this range to fair market value, right? Or not even trade back to the range at all. Okay? We trade back through the range, we might have a body closure through fair market value, so on and so forth. But obviously, we trade through the end of the range, right? At that moment, we have a dealing range. We've taken out buy side liquidity, we've taken out sell side liquidity. All right. Now, in doing so, obviously, there's going to be some type of fair value gap within this range. All right. So there's a fair value gap in that range. And we know that the market, earlier we spoke about the market trading from buy stops to sell stops, creating imbalances, and then wanting to rebalance that range. All right. Price is going to want to trade from discount to fair value. Here we are. We trade back higher into the inefficiency, right? And then we trade back lower. Right? At this moment, right, and you guys can turn your mics on and answer. At this moment, what do we now have? Right? We can engage a little bit now. What do we have at this very moment?
Dealing range.
You have a new dealing range. Absolutely, right? We have a new dealing range. So we should see it like this, right? This is 1. This is 2. This is 3. This is 4. Right? So you don't have a dealing range until phases 1 and 2. All right. So most questions that arise are, hey, how do I know it's going to be a dealing range? You don't know. Why? Because it's not a dealing range until it's a dealing range, right? So now, starting out, most of what you guys will perceive is phase 3, which is here, the rebalancing of the range. All right. Once the range is rebalanced, remember this key point. Phase 4 should always take out 2. All right. Keep that in mind because you're going to see something here in a second. Let me move this. All right. So that's 4. Now, let's imagine, right? Because obviously as traders, we can't just be stuck on that lower time frame or what we're seeing on that lower time frame. Okay. So let's understand that when we're looking at this price action right here, and just give me a second to draw this out. When we're looking at this price action, right, there's a much larger pricing sequence that's taking place, right? We should see here, price took out stops. From a higher time frame perspective, we're thinking imbalance or inefficiency back to stops. All right, keep that in mind. All right, now let's zoom back into here. All right, so when we're looking at this, we got 1, buy stops taken, 2, sell stops taken, 3, back into the range to rebalance, and then 4. Well, obviously, if we got a new daily range, technically this becomes a new 1. This becomes a new 2, right? And then we have to understand there's going to be some form of displacement inside of this range. All right. Now, price chopping down into here, right? Price rallies higher, right? And then we should be expecting price, right, to create this phase 3, excuse me. And then 4 should always take out 2, right? 2, and looking at 2 in red, all right? 4 should always take out 2. Okay. Well, we run through here. We run out the sell stops from here. And obviously there's going to be a down close candle. All right. Down close candle is going to be right here. Down close candle is there. We run into that down close candle, taking out sell stops, and then price trades back higher, taking out 3. So now what do we just create? Don't be shy.
Failure swing.
Yes, failure swing and a bullish dealing range right here. Right? You see we take sell stops, we take buy stops. Right? We've also created a swing low fractal. All right. So buy stops, sell stops. We're also seeing that this down close candle, right, has caused a new change in state of delivery, right? Telling me, hey, down close candles are supporting price. Right? Why is that important? Because if I zoom out, right, cause and effect, response. Where is it happening? It's happening at this inefficiency, which is a part of a higher time frame pricing sequence. All right. So once I zoom into here and we see that, right, here's a rule. If 4 fails to take out 2, right, speaking about the numbers in red, if 4 fails to take out 2, right, and instead takes out 3, creating a failure swing, right, the draw of liquidity is 1. All right. So in looking at this, right, we take out sell stops, take out buy stops, right? There's going to be some form of displacement within here. We're going to rebalance the range, and the draw becomes 1. All right. You should see what's happening right here, right? It's everything we just spoke about. Okay. This is price engineering liquidity. This is price neutralizing liquidity, right? And all of this is that phase of distribution, right? Trading through the stops of the higher time frame or the parent price swing or the intermediate time frame, right? Because we just saw a much higher time frame. All right. You should also see a degree of order flow. Down close candle here, change in stage delivery, down into that imbalance, down close candle here, right? Now it seems like these down close candles are supporting price, right? If you think about the delivery from a higher time frame perspective, this whole piece is a down close candle. If I zoom out, if you think about this delivery, this whole piece is a down close candle, right? That price is trading into. We may be in a market where still here. Price is respecting higher time frame down close candles, right? Order flow from a higher time frame perspective is bullish. Okay. So these retracements, right, are retracing to the extent of a higher time frame institutional order flow point, right, in price. Every movement from here to here, that's a buy program. What you should see up here is a buy program. Everything that just happened right here is your smart money reversal. What is a smart money reversal? A change in institutional order flow, right? Premium arrays stop being respected, discount arrays start being respected, right? And it's not just that that's happening, it's happening why? Because it's reaching a higher time frame institutional point of interest, right? Or reference point on the chart. Okay. So this is those rules, all right, for that dealing range. Like make sure you have notes in terms of that. Okay. So what we'll do now, and obviously just with this last piece here, if we just ran out these stops, right? So think about this, right? I know the chart is getting messy, but at this point, what do you have? A larger dealing range. What do you have? Engineer, neutralize, distribute. What's next? Rebalance, right? I'm going to look at my PD array matrix, right? Maybe even from this low to that high, I'm going to go through that PD array matrix. Oh, I have an inefficiency accompanied with a mitigation block, right? Why should that mitigation hold? Well, for one, I understand the entire pricing sequence. I understand that this is a bullish dealing range, all right? And this portion of price, right, is efficiently traded. At most, we come to fair market value, right? That point in price should hold. Now, when price comes down here, am I just going to enter? Hell no. Why? Because high probability pricing sequence is fractal. What's going to happen? Rebalance. Boom. Stops to inefficiency. Inefficiency to where? Stops. All right. So I'm going to have to clear some of this. All right. Because I want you guys to understand this very important piece. All right. When I look at this for me is like looking at 3 candles. Or even this is like looking at 3 candles. Why do I say that? Because a candle is not a candle without delivery. You don't get a candle without delivery, right? I don't get this. This candle it's not. That's just not a illustration on the chart. This is price. This is movement. This is delivery, right? This is delivery from the opening price to the low, to the high, to the close. Beyond me just seeing that as a candle, I have to see, right? It's like having X-ray vision. I have to see what happened. in this candle. All right. So we have that candle here. We have this candle. We have another candle. And then we have another candle. Somebody give me the pricing sequence with these candles right here. Like if you had to give me these candles from the stance of intellect, like if I was blind, if I was a blind person, right? And you had to explain to me what's happening in this point in time, from this point to this point. If you had to explain to me how would you explain this to me if I could not see it all? And this is where you guys can chime in. Where's my guy who answered the question earlier? Let's check the chat. You guys are scared. Yeah, you. Let's go. You can answer. If you had to explain this delivery to me, what would you say? I cannot see. I can't see anything on the chart. I can hear, but I can't see.
Uh,
Think about what
I
you would
I don't understand the question, bro.
Okay. All right.
I
So
think I think I can explain it.
okay,
I'll try.
yes, sir. Let's go.
Okay, so I see in the first candle price engineered liquidity, it neutralized and it distributed, perhaps.
All right. So the first candle, let's take it one step by step, right? We may have some that may not fully understand just yet, right? But they will. This very first candle is engineering, right?
Yes.
All right. So we'll bring this down here. And you're absolutely correct. All right. So that very first candle, we're seeing price engineer liquidity, right? That delivery, let's actually draw the delivery out from each candle. So that very first candle, it opens, it creates a low, trades a little higher, creates a high, and then it closes. All right, what happens on the next candle?
Mm, neutralization.
Exactly. We're neutralizing, right? So that candle opens, a little lower, a little higher, then we close. All right, cool. Okay. So what happens on the next candle?
It distributes lower after taking
Exactly.
buy side liquidity.
Exactly, right? So next candle opens, trades here. That's actually going to be a failure swing. All right. So if you think about that, to that, to that, to that, it's a failure swing. All right, which we'll talk about next lecture. So we distribute, right? We distribute. What do we have at this point?
A dealing range, a new
A dealing
bearish
range.
dealing range.
Exactly, right? We have a bearish dealing range. Look here. Here, and then here. Right? You look here, that candle. Maybe I should just say power of three, right? Accumulation, manipulation, distribution. Right? What comes after that? This is accumulation, manipulation, distribution. That's what we're saying. All right? We've created displacement. Now, what's happening on the fourth candle? So that
Rebalance
third,
and redelivery.
exactly, right? That last candle rebalances the range, redeliver. All right? This delivery, right? The entire market points back to that one delivery, right? So we can take this candle or these candles, right? We can bring them up to this chart, and you guys should see that that's literally the same. It's the same price action. All right, nothing changes. That very first candle was accumulation. Take your eyes to the first candle. Price is accumulating. Take your eyes to the second candle. It's trading up. It's neutralizing. Third candle, right? We distribute and then we come back inside of the range, right? The fourth candle, it's rebalancing. Right there you see 0.3. That's price rebalancing, and then it redistributes. All right. Now, what you have to understand is that same pricing sequence, right? Because what you're seeing is prices turning around, right? That's a change in the state of delivery. It happens on the lower time frame here, from an inverse perspective, here, even here inside of this down close candle, there's lower time frame delivery, right? Also here, right? That delivery, that high probability pricing sequence, that one delivery, you will find that delivery, right? And of course, we have to go more in depth throughout mentorship to understand the much more intricate details of this delivery. You will find that delivery at almost every turning point within the market. All right. But even beyond just the fractal sense, that same delivery, right, gives you framework in terms of an entire market, right? For understanding where you are, what's happening within a certain pricing sequence, so on and so forth. All right. So let's go to a chart and let's look at some examples. First off, does anybody have any questions at this point about anything? All right, cool. All right. So I always like to start with this particular example from the euro. All right. So if we look over here, the very first thing we should notice is what is price doing? Stops to imbalance. Stops to imbalance. Right. So think about it. If I'm a trader in this moment and I'm looking at price action, and this is a daily chart, right? But remember, the idea is fractal. The concept, the theory, or the discipline is fractal. Okay. So if I'm a trader, I'm looking at this range and I'm saying, hey, right, price took out stops. Now my framework is that price will trade to an inefficiency. All right. Well, it should go from inefficiency back to stops, right? Or we consider this a point of fair value. What forms and areas of fair value? Order blocks, right? How is an order block created? There's a certain delivery that creates the order block. Okay. So we have this range of price. So I'll just give you guys this so we can focus on it. And we're coming back into an inefficiency. Okay. So we're going to kind of go from big to small in terms of the delivery right here. All right. So look at this very first portion of price. And you should see right here, this is that phase of price engineering liquidity, right? Or what else can we call this? Can somebody answer this?
Dealing range.
Well, let's say we didn't even have this part yet. Like, let's say we were right here. And all we had was that part.
Balance price range, exiting the balance price range.
Yeah. We have an efficiently traded price range, right? We exited, right? Body closure, some degree of speed. All right. So this is like price has kind of chosen its fate, right? If it's exited the range this way and it's bullish, we should not see price even close below fair market value. All right. So that's one thing to keep in mind. All right. So the moment we come back below, we've certainly closed through fair market value, right? What have we done to that inefficiency? Close below that inefficiency. I can guarantee on a 4-hour time frame, 1 hour, right, you're seeing discount arrays being violated at this point. All right. So what do we say when price goes stops and it says screw the imbalance, we see that as an indication of an opposing stop run. What is an opposing stop run? That just means the liquidity on the opposite end of the range. All right. So this is a daily chart. There's so much you could do with this information at this point. Okay. So we trade lower. Now we have what? Bearish dealing range, right? We have a bearish dealing range, and then we can measure this part because this would have been fair market value. You see how price closes through fair market value, all right? So we have 1, 2, right? Engineer, neutralize. What are we thinking now?
Rebalance.
Rebalance, right? We're thinking, hey, price needs to rebalance the range. Okay. To what extent? To the extent of fair market value. We don't really want to see it push too far beyond that point. All right. Or start closing beyond that point. But that's a little more advanced. For now, just stick to your understanding of buy stops, sell stops. Now we're expecting some form of rebalance and redistribution. All right. Okay. So we trade back up. Now, what are we doing right now? Because it's fractal, right? What's happening in price at this very moment? Price is engineering. It's going back through that same cycle. It's engineering liquidity. We trade up. Now, this is that 1, 2, 3. We're anticipating that 4, like this would be 4, should take out 2, right? All right, there we go. So now, basically, there's multiple dealing ranges within this one image. All right, so here's 1, 2. We rebalance the range there, and then we distribute, right? That's 4. All right. However, because the algorithm or IPDA understands that it needs to rebalance this range, and watch this. Look, where does it rebalance the range to? Fair market value, right? To the extent of fair market value, right? Use your understanding IPDA first. It wants to offer price efficiently. If it chooses its fate this way and it comes back and closes through price this way, well, at most, it should only come back to fair market value. All right. So you're blending concepts. All right. We're taking years of ICT videos and we're basically putting all this shit into one. All right. So that's 1, that's 2, that's 3, right? 4 distributes and takes out 2. However, because IPDA understands that it's in a phase of rebalancing here, right? Guess what it does? It engineers liquidity right here, right? Engineers there, takes it out. Now this becomes the new 1, right? That's the new 1. Guess what? Trade back through the opposite end of the range. That becomes 2. So as a trader, what are we waiting on from a daily, even a daily standpoint? We're waiting on the rebalancing of this range. We're waiting on phase 3, or we're not necessarily waiting on it, but we understand that should happen because there's so much more going on a lower time frame. All right. So before we go through the rest of this piece, I want you guys to look here. All right. So as a trader, we're understanding price is trading from stops to inefficiency. If I go to a weekly chart here, just really quick, let's go to a weekly chart. We understand that order flow is bearish. Why? Because those candles are supporting the direction of price. All right, so I don't really expect price to trade through this end of the range. At most, we come to a discounted rate. All right, so order flow is bearish. I'm looking at this range. Price is trading stops to inefficiency. I want it to trade to inefficiency, and I want to see signs of changes in the state of delivery. I want to see bearish dealing ranges, so on and so forth. Okay, so if you look right here, if we take this very first candle, I'm sorry, not this candle, but if we can even take these 3 candles, all right, because these 3 candles are basically within the same range of each other. All right, so if I look at the delivery right here within those candles, this within itself is a balanced price range, all right? But if I look at those few candles, I want you guys to think about the delivery right here. That would be buy stops. We run out buy stops. This would be sell stops, right? This is 1. That's 2. Rebalancing that range. All right. Still to the point of fair market value. So you guys should see that point in price becomes highly important, right? And then we get away 4. Remember earlier I told you guys order blocks that are formed at fair market value. So at one point in time, we would have viewed this as an order block. Boom. These guys should hold. Okay. Now, the inverse applies if we trade through that point. So this is what we consider overlapping arrays, right? Yeah, this, this now will become a breaker, right? But obviously we take it a more in-depth understanding that this was actually formed at fair market value of this range, right? So that area becomes super sensitive. Okay, and this does not just apply to a daily chart. This applies to this applies to even a 30-second chart. All right, same application, same understanding. Okay, you should also take a look at this portion of price. All right, so just to walk you through the thought process, I'm a trader. I'm looking at this price range. I'm understanding that institutional order flow is bearish. I have a bearish dealing range. We're in phase 3 of this dealing range. We should come and rebalance and then get away, right? We engineer buy side liquidity here. Okay, and I'm looking for signs of that change in delivery, change in state delivery, change in order flow, and a bearish dealing range, right? So let's take this one candle, this very first candle. We can literally look at this one day of price and understand that that one day of price is literally that very first phase of a dealing range. So that candle opens a little low at the bottom, trades here, and then it seems like it spends most of its time down here. All right. Now the next candle, obviously there's a gap up. However, it takes out buy stops, right? And comes and closes here. The next candle is looking at the bearish candle. Opens, trades higher, right? Doesn't really make it above that candle's high, a little feather swing. And then what do we get? Displacement. See this candle? This is speed. Okay, cool. Well, at most, I'm going to expect fair market value. Even if I didn't understand that, I'd still understand that, hey, I have a bearish dealing range. I'm thinking 1, 2, 3. Rebalance that range or engineer, neutralize, distribute, right? Now I'm thinking rebalance that range, literally right here, rebalancing that range and then redistribute, right? Price comes back up here and then it redistributes. Okay. So even if we measure this point of this candle, almost right to the mean threshold or the, fair value point or fair market value point of this little range. All right. So now let's take the zoomed out perspective. We'll probably have to scan back over. All right, cool. All right, look at this. So remember, we had this dealing range here. There was 1, 2, and we were saying, hey, I want to see price come back up, rebalance the range, and then get away. Price runs back higher. For 1, we start negating imbalances. We even trade up here, screw the imbalance. This is an indication of an opposing stop run or a future opposing stop run. What does opposing stop run mean? A stop run at the opposite end of the range. All right. Now we're negating imbalances, but what's more important? What's more important is why is that happening? All right. Why is that happening, Chris? Because there must be some type of higher time frame array that should cause this. True enough, right? Price reaches down into a quarterly inefficiency. All right. So that quarterly inefficiency, cause and effect, right? Response. You have to have a response-based approach to price action, not just what we anticipate through the lens of terminology, right? Because everybody can say what an order block is, a breaker block, but like how do we engage with that? Okay, that's what's important. All right, so we trade up here, we're negating imbalances, right? We're also keeping in mind that we traded into that quarterly inefficiency. Okay, now price rises back here, So once again, that's 1, that's 2, that's 3. What was the rule for 4, right? 4 should always do what? Take out 2. If 4 rallies lower, think about it. What do we create? Down close candle. What do we call it when price trades above that down close candle's high? Change in the state of delivery. All right, we're going to look at this area too in depth. Okay, price trades down into that candle, and then what happens? Right, that candle forces a new change in state of delivery. We can take this candle or this one. Actually, let's just take this candle. Right, that down close candle. We trade back above the high of that down close candle. So you have down close candles forcing new changes in the state of delivery. Or we can just say down close candles are support price, right? Premium arrays or sell side imbalances are beginning to be negated. All right, so now we're seeing signs here. Okay, 4 fails to take out 2 and instead takes out 3, creating a failure swing. Right, creating a failure swing. Price trade stops. Right, now I know we go beyond the inefficiency here. We go down into down close candles. Right, this is just a super engineered move. I remember this. It was like NFP around this time somewhere. I think it's on this date. Is that yeah, it's a Friday, right? This is NFP. First of the month, November 4th. I won't lie to you guys. All right. So we come back down, and if 4 fails to take out 2, instead takes out 3, right? The draw becomes what? 1. Boom. And understand when I'm saying if 4 fails to take out 2 and instead takes out 3, I guess that would be intellect, right? But technically what I'm in saying that the visualization is that means that down close candles are being respected, right? 4 taken out 3 means that an up close candle or a premium array is being taken out, creating a failure swing, right? Creating bullish changes in the state of delivery. Okay, which is why we say that means that the draw becomes 1, right? Let's take our attention to this area down here. All right. Before we do that, I want you to simply look at this very first candle and look at what happens to both sides of that candle. Price takes out sell stops and buy stops. What is that wick doing? This is engineering. That very first candle is engineering liquidity. That next candle is neutralizing, right? And obviously it does it neutralizes, and there's the distribution is within that same day as well. All right. So we have that. That next day, this is where price rebalances. So engineer, neutralize, distribute, rebalance, right? And then back up here is redistribute. Okay. If that confuses you, please say something now. But we're going to dig inside of that area. All right. And just break the delivery down. Okay. So going to a 4-hour chart, you can see more of what's happening here. All right. Look at this portion of price. Right. Price is offering buy and sell side through that area. That area is efficiently traded. Let's measure that area. Fair market value, right? Let's put the rest of the puzzle together. All right, so let's take this little range right here, right? Because that's balanced also. So we're going to take this range, and we see sell stops are taken, buy stops are taken. At that moment, we have that's 1, that's 2. And as a trader, I already understand range is efficient, price traded this way, but then came back with speed that way at most fair market value. I should see bullish order blocks form within this area. All right, we talked about fair value. Speed, taking out a high. Speed, trading through that high. Order blocks form in areas of fair value. This is from a zoomed out perspective. Now let's zoom inside of this and take a look at price action. So as a trader, my mentality is, hey, right, we've tapped into quarterly inefficiency, right? That higher time frame dealing range, right? We saw imbalances negated, right? I'm just putting all the pieces together, right? This is how we have to think. We got to use all those things that we know and figure out how does it make sense from a logical standpoint. So just to draw, I'm a visual guy. So just to draw what we're dealing with here, we have this tapping into that quarterly inefficiency, rallying higher, and now here we are at phase 3. What's going to happen at phase 3? Price trades down. Remember, I told you that idea of engineer, right? Engineer, neutralize,
Neutralize. Rebalance.
exactly, right? Rebalance, right? So we're at the rebalancing phase of the higher time frame, but also look at what you're seeing as price is getting into here, right? It's going back through that same fractal. Okay, so let's go to a 10-minute time frame. Yeah, going through that same fractal. All right, engineer. What type of signature is this? This is low resistant, right? Low resistant. Engineer, neutralize. What was happening before this? Price was trading stops to inefficiency, stops to, oh shit, what happened to the inefficiency? Market structural shift. Why is that market structural shift important? Because we already expect price to turn around anyway. So now I'm seeing signs, right? I'm using logic. The engineer, let's sell side liquidity. We took it out inside of phase 3 of a higher time frame dealing range. And then we're negating that imbalance. Okay, cool. Maybe not enough just yet. Down close candle, change in the state of delivery. Still not enough. All right. Down close candle, change in the state of delivery. Down close candles are starting to support the direction of price. Maybe not enough. Efficiently traded price range. Right, and I can even take the bodies here. You guys will kind of learn when you should take the bodies and when. It's not necessarily a means of taking them and not taking them. It's just, I guess it's more intuition than anything. All right, some things just can't be given to you. It's more you got to engage with price. But anyways, we trade down through that efficiently traded range here and then back up. Well, at most fair market value. All right. However, 1, 2, 3, boom. We zoom out. Let's say we only understood dealing ranges here. Our entry model was in this. All right. But let's say you only understood dealing ranges, and let's say you take that entry and price shouldn't negate that imbalance, but we're not worried about stop size and TP size. But if you understood that 4 should always take out 2, right? Then obviously, you'd have TP here, all right, because we should be attacking that high at the opposite end of the range, all right? And then you can go deviations of an efficiently traded price range and see how far price will trade from that point also. But that's the thought process that you will go through, just understanding and interpreting price. All right. We can go through last week and just see if there are, which there always is, every single week, there's dealing ranges all throughout the market. Anybody have any questions, right? Any questions that jump off the top of your head right now? Right. All right. So if you guys look here, this is Tuesday's price action. All right, going from the London session to and through New York. All right. So we didn't come exactly. Yeah, we didn't come approximately to that point. But anyways, if I zoom out, right, what's my thought process? stops to where? Inefficiency. All right, cool. I should expect bearish order block to form. Okay, cool. So bearish order block should form. Looking at my 15-minute chart, we're seeing buy stops taken, sell stops taken, right? Or we're seeing engineer, neutralize, distribute, rebalance, redistribute, right? Same cycle over and over and over and over and over again. You can even see it here. 1, 2, 3, right? But why is this probably not the most highly probable scenario? Because, right, price is trading stops, it's trading sell stops to sell side imbalance. Right? So I'm not going to fight against. Remember, that imbalance is superior. Right? I'm not going to fight against that sell side imbalance based on what I'm seeing on a lower time frame, 15-minute time frame. I'd much rather be looking for sell scenarios. Okay. Let's go. We can even look at it here. See that delivery here. You can take that high and that low. There's one, right? There's two, even right here, and then we're rebalancing that range, and then price is getting away. There's another one there. There's literally everywhere, guys. Here, right? Engineer liquidity, we neutralize, we distribute, we rebalance the range, and then we distribute. I can even look at this one candle. Let's dig into that candle and let's see if we can see the delivery on maybe a 1-minute time frame before we even get a market structure. Right, there it is. So let's go. Right, the image is already there, but I'm just trying to give it to you guys from perspective that won't be too hard to pick up. All right, anyways, the same delivery, right? We're engineering. All right, so we engineer, we neutralize, right? We distribute, we rebalance the range, and we redistribute. If you're on the fence about if price takes that high, right? Well, guess what? It takes it right here. All right. What am I seeing? Imbalances are being negated, right? Down closed candles are creating changes in the state of delivery. Boom. Right? That dealing range fractal is everywhere. Okay, but then you just have to learn how to zoom into price and see it from literally 3 candles. But it has to make sense for where that occurrence is taking place at. Scan through. Right? Obviously, this piece of price was a mess. However, right, still right here. This is one of the images from earlier. But anyways, 1, 2, right? That's 3, and then you can see redistribute. Same idea as here. Price is engineering, right? Neutralize, back to the opposite end of that range, and then boom. Let's measure this range for a second. All right, so we come back down, right? Fair market value, and then we go the opposite way. Dealing range here. One, two, engineer, neutralize, distribute, right? Rebalance, redistribute. Same ideas here. Engineer, neutralize, distribute, 1, 2, right? Rebalance, redistribute. Right? Does anybody have any questions? So what I'll do now is literally open the floor for any questions that may arise, any misconceptions, literally anything that you guys will want to ask at this point. And if not, we'll end the call there and we'll prepare. I'll give you guys will have homework. We're working on just giving you guys a quiz where you can go through, and then also you'll have, some actual engaging homework to go along with this, just to make sure that we're fully understanding this part as a collective. But I'm a questions guy. Like, I want to make sure that everybody leaves this call with the understanding that they deserve. So please ask away. If you're shy, it's okay.
Oh,
Can I ask something? I'm a complete beginner, so I have been learning the ICT stuff. What I wanted to ask was about the fair value area that we are looking to get in the trade. Typically, what I learned from those videos from previously from ICT was we would look for the discount stuff, which should be, the PE rate that you spoke about, which is typically in the 61.8 to 78.6 area. But looking at what you showed us earlier, it was pretty much the 50% area. So is there a reason why the logic has changed in that sense? Obviously, seeing what you presented is obviously a lot better, but I'm trying to understand the logic behind why sort of the change in delivery is happening there instead.
Yeah. No. Your question, first off, I want to let you know your question makes sense completely from the stance of just stepping into this space. All right. So no question is a bad question, right? Ask me anything and challenge anything that I say. Okay. So now when you're speaking about the 61.8 part, that you're speaking about an entire range. All right. And I'll say this, we don't want to be fib guys. All right. It's not about 61.8. It's not about 79. It's about premium and discount. It's about what array is within premium and discount and what is price doing at that array, right? It's not about 61.8 or 79. That's just a reference point. Okay. Now, but when you're speaking about 61.8 and fib levels, all right, which I guarantee by the end of this mentorship, you won't pull out a fib with numbers on it. You'll just literally pull out something with premium discount. That's all you would care about. All right. When I'm speaking about the 50% point, what I'm referencing is it's not the whole range. All right. This is a more advanced viewpoint. What I'm speaking about is this part of price, all right, before that range is even created. All right. So I'm focusing on this part of price. All right. Now, what's going to happen next is price is going to say, boom, it's going to leave that part of the range. That range is efficient. We just left that range. So I don't really expect price to have to trade so deeply back inside of this range. All right. But if price tells me, hey, I'm choosing my fate this way, and then it says, nope, I'm going back this way. That point of fair market value, when I'm saying fair market value, this is where you're seeing me talk about 50%. Now, to blend, what we're both saying, to blend that together, the 50% point of this efficiently traded price range might in some cases be 61.8 of the entire price range. Does that make sense?
Yeah, that makes sense now. Thank you. And you also mentioned within that box about the or any range. You mentioned the break of the high. I saw you used a pin sort of to break the high. So we don't care about the body or the pin in that sense either.
So it's more about, so when I'm saying basically, so that points back to where I'm saying there's two ways that price can leave a range, right? Now, any discipline that we apply to a chart, it has to have rhyme and reason. So what I'm not saying is only look at price when it closes or doesn't close. I'm not saying that, right? We have to advance our understanding. Okay, and it will if it's not making complete sense now, keep showing up because it will. All right, I promise you. Trust me. When I'm speaking of that, what I'm saying is there's two ways to leave a range, right? Right. If this range is efficient, okay, and let's say the range is efficient, and we exit the range, right? I'm like, oh, I'm waiting on price to leave the range, right? And we leave the range. However, I start seeing rejection blocks form, right? So it could even close below the range, right? But if I'm seeing rejection blocks form, that's an indication to me that, all right, this is probably going to be an opposing stop run. It's like what we saw. I saw a lot of people take shorts on Euro USD on Thursday, I believe, because they saw structural shift. They saw a fair value gap inside of the range, right? They saw ICT's 2022 YouTube model. And they went short from this here because it lacks understanding, right? Rejection blocks are forming at the bottom of that range. I'm not taking part in them. And I'm certainly not just trading a fair value gap. I'm looking at lower time frame delivery. Leaving today, you guys should understand if price is going to turn around, it's going to give you that high probability pricing sequence. All right. The other way that price will leave a range that we want to see is leaving that range with speed. Right. Now, this is where I'm excited. Why? Because, all right, shit, that range is efficiently traded. We left the range with speed, right? There's still lower levels of liquidity, right? Price comes back into this little area of fair valuation, right? And I'm expecting bearish order blocks to form. That delivery is going to create a bearish order block. All right. Any other questions?
Sorry, one
Yeah,
last
good
question.
work.
Sorry, one
Yeah.
last question.
Yes, sir.
Your rejection block earlier, that's completely new
Mhm.
to me. Could you just go through what a rejection block is, please?
Yes, sir.
Thank you.
Absolutely. Yep. And I love the fact that you're asking questions. Do not feel like it is a burden to me for you guys asking questions. That is what you guys are here for. All right. All right. So right here, rejection block. All right. And of course, that we could scale to lower time frames and we'd see more of it. When price leaves here, right? You see how these bodies of candles, there's like an approximation in terms of where those bodies or where the volume is stopping at. You have down close candle, followed by up close candle, right? There you go. There you go. So just to intellect, right, or just understanding it beyond seeing a visual, it's like there's approximate stopping of volume at that area. It's a rejection block. The rejection block is basically you have equal bodies on a chart. This area will, in the right scenario, will be strong in terms of, if price trades back into it, you may see it react from it. But even from a beginner standpoint, I don't want to see price leave a range and form rejection blocks. If you go back to a higher time frame, when we were trading lower, this was a while ago. So when we were trading lower, I'm saying, all right, I want to see price take out this low on euro, but I don't want to see rejection blocks form. All right, I want to see speed through that low. So even on the daily time frame, right? I wanted to see speed through that low. All right, see the fair value gap created here, right? Price trades back into that. All right, and then we continue to go lower. All right, now it's looking like as we go into next week, we're probably going to get that retracement that I was speaking about because we ran out. I think this is the Q1 lows. Does that answer your question, sir?
Perfect. Thank you so much. So much.
All right. Just remember, right? In your study, just remember rejection block. We're going to see even bodies. All right. And it's showing me some degree of approximation that volume is stopping at that point. And of course, you're going to learn the proper framework to apply this. It's not just anywhere on the chart. Everything we're doing is cause and effect. All right. I had somebody else that had a question.
Yeah, I had a question. So
Yes, sir.
when you took out sell-side liquidity and it came back up into an inefficiency, when it failed to respect it, I mean, how do you know when it fails to respect it? And then you said that was a change in state of delivery before you gave all the other examples, if that wasn't a confirmation. Because I was kind of confused
All
on
right.
that.
So yeah, great question. So give me the question again. I'm going to try to draw out a visual to make sure that I understand completely what you're asking, so I can answer you correctly.
Okay, so you took out sell side liquidity, and I don't know if that was in like a higher time frame array,
So
and
we're taking
then
out. Mhm.
yeah, and then it created like the inefficiency, like the fair value gaps, I guess, and it failed to respect it, and you were like, right there is a change in state of delivery, but then you started giving other examples. I was kind of confused on that.
Okay. Yeah. So all right. So think about when we say, hey, prices trading stops to inefficiency, stops to inefficiency. All right. So this market wants to, when prices offered efficiently, it trades to the imbalance. Now it's going to seek liquidity. To the imbalance. Now it's going to seek liquidity. All right. Now it's going to do that up into the point of that higher time frame array that you were speaking about, right? So once it meets that higher time frame array, just keep in mind we had inefficiency. All right. Because one of your key notes from today was understanding that price is going to trade stops to imbalance. All right. At least until it meets a higher force, right? Which means that higher time frame array. Now, there's going to be an imbalance right here. Okay. Once it reaches that higher time frame array, if price reaches that array, right, and it shows me a new degree of behavior, right? What is that new degree of behavior? Instead of respecting the imbalance, right, price has a full body closure through that imbalance. All right. So, you know how most of the times you see an imbalance here, right? There's an imbalance, price comes back, and this kind of blends into my other buddy's question a second ago. Price trades into that imbalance, and then we might see something like rejection blocks created, right? Showing me respect for that inefficiency, right? And then we'll see price go here. Okay. Well, this image that I've drawn below is literally the same as the one above. However, instead of respecting that inefficiency, price goes here and we have a body closure through that inefficiency. Right? So we see that as a market structural shift. And what's significant is not just because this happens. Why is it happening? Why has there been a change in behavior? Because price is traded down into a higher time frame array. All right. Now, tell me first, does that answer your question, or does that guide you in the right direction?
Kind of. So basically, what you're saying is, if it wicks, then it respects it compared to like a solid closed candle through it.
Exactly. Right. Look at this right here. You see this? Look at this. Watch this. Price trades through stops, right? There's an imbalance. Does price show any respect for that imbalance?
Yeah, no.
Nah, it closes, right? That's an indication that price is concerned with stops. So remember, we say stops to imbalance. All right. So when price runs into a discount array, right, and then trades back up to the imbalance and says, screw the imbalance, what's the only thing on the menu? Stops, right? So if price isn't showing concern for rebalancing a range, then it's probably trading to the opposite end of that range.
Okay, so I got another question.
Yes, sir. Ask away.
On one time frame, it could be respecting it, but the other it could like take it out. So how do you know which one to look at?
Because this is what's going to happen. That's a great question, right? What's going to happen is if that's an inefficiency, okay? If let's say on this time frame, this is a 30-minute time frame, that price pushes up there and closes. All right. Now on the lower time frame, because you asked how will we know? Okay. You know, because on a lower time frame, there's going to be a certain delivery, right? If you get a certain delivery, that delivery is going to lead to lower prices, right? I can guarantee you within here, the delivery that we want to see does not happen, right? Let's go to a lower time frame and look inside of it, right? And one thing that exactly, the delivery does not happen. So one thing you guys have to understand is nothing about today has to do with telling you how to enter into a market. It has everything to do with getting you to focus on framework, right? So if I were looking at this chart and price trades up into here, remember, I don't care that an inefficiency rests. I'm not going to say I don't care. That's not the only thing I care about. I care about price's response, right? So think about this. When price reaches up to that inefficiency, order flow has to be bullish for a small degree of time. We trade here. The only way it's going to get up here is if order flow is bullish. It can't, otherwise it can't go there, right? Meaning that down closed candles are going to be respected. All right, now we're inside of that inefficiency. Okay, now if down closed candles are being respected, that means we're on the buy side of a curve, even on the lower time frame. We're inside of an area of potential, right? We have to stop taking the array for face value. We do not control the market. Stop trading the key level, trade the response. So if you take a short right here, you're taking a short, and the market hasn't told you anything different than what it was telling you down here. So when you say, well, if it's even though it's respected it on this time frame, or it's not respected it on this time frame, that 30-minute time frame, how do I know that it didn't respect it on the lower time frame? Right? Because right here, look, there's a certain delivery that I want to see inside of that array. Right? That delivery would be down closed candle. Once we get in that array, I would want to see something like this. Engineer, neutralized, down closed candles taken out, or discount arrays taken out. Maybe an imbalance was created on a lower time frame in here. Let's go to a 1-minute chart. And when you guys get the entry model, you're gonna understand this. Right? This is why the entry model is so vital, because you don't get the delivery that you want. Remember, there's a certain delivery that creates the order block. What is the order block? The order block is the change in stated delivery. Right? We never got a change in the stated delivery right here. Price could care less about that imbalance. Does that answer your question?
Yeah, answer the question. Thank you.
Okay.
Chris, I've got a question. If we go to the daily euro dollar,
Mhm.
can we say that it went to a higher time frame PD array and it disrespected the inefficiency?
What level to be exact?
It went to the higher time frame PD array, and now it's if it disrespects this inefficiency, are we thinking that we're going to a buy side liquidity?
Absolutely.
Okay, so if it disrespects this inefficiency, then we would try and go to the buy side liquidity.
Yeah. So like look at what we're having here, right? You see this? Actually, I'm sorry. He's
Yeah, this is exactly what I'm saying because I'm looking at my chart and it looks exactly opposite to what you're looking at.
yeah. So I'm telling you guys, like, just trust me, please. Like, trust me. This is exactly what I'm saying, right? Look at what's happening. Price is closing those inefficiencies. It's not. It's basically saying I don't care about an inefficiency right now. So if it doesn't care about the inefficiency, then what's the only thing on the menu? And you kind of already answered the question, right?
The buy
Stop.
side. Yeah.
Exactly. Right. So now in that regard, what we'd have to do right next week, once we have a weekly outlook, we're going to be looking at higher time frame discount arrays or premium arrays. So my focus and my attention, if we do that, is going to come to this area in here. All right. Understanding that that's a breaker. We'll be looking inside of this area to see if price wants to trade up into that area. It's because we've kind of exhausted sell side liquidity, right? So we have to anticipate some degree of a rebalancing of this range or trading back inside of this range. All right. Nothing changes from what we spoke about before, right? Engineer, neutralize, distribute, right? We should see some degree of that, then that. All right. Now, to what extent we come in here, my very first point is looking at this higher time frame breaker. We clear on that one?
Yeah, thanks, Chris.
Okay, cool. Perfect. Next question. Just check the chat. All right, cool. All right. How can we differentiate the price from taking out one to just liquidity sweep and continuing down? Jay, are you still on the call?
Yes. I don't know if you can hear me.
Yeah, I
tried
can hear you
talking,
clear.
but I didn't get in. Okay, cool.
Okay.
I think you've already answered that question.
Okay.
Just the last one. Yeah, pretty much that.
Okay.
And I
Are we
also
sure?
have one more question.
Yeah. Let's
Yeah.
ask away.
I'm clear with that. I just wanted to know that do you advise not trading the counter trade or the rebalancing range and
Okay,
just wait for the
that's a great
rebalance?
question. That's a great question. So basically what she's asking is if we have this, right, and you're saying you're saying just wait on price actually getting there instead of trying to trade into there. You're saying just wait until it gets there, right? Is that what you're asking?
Yes, that's right. That's right.
Yeah. Yeah. So when it comes to that, right? This is where in your trading plan, right? And the answer to that question depends on your risk tolerance, your unique makeup as a trader, right? Me, I don't care to catch every single move. I care more about the highly probable scenario. All right. And the reason I'm not giving you one objective answer to that question is because there are different scenarios, right? So it's almost like uh in some cases, all right, you may understand that there's a level up here, maybe from a higher time frame, right? That you know that okay, cool, price is exhausted. We've created a swing low down here, and I know for a short period of time, maybe over a couple of days, we're headed into that weekly or monthly imbalance. All right. And but you have to make that decision. But I would say you do come out better if you can just sit on your hands and be patient, right? And wait on this move. There's no reason to fight against every single move going higher, because in a market where order flow is bearish, price is going to have a tendency to find every reason to get back bearish, and you don't know when that's going to happen. All right, so I'd much rather wait on this move up here. That's a good question.
Yeah, got it. Thank you.
Is it possible to know how many pulses a market maker's sell model will have? So think about it. This is based on the range, right? You go through your PD array matrix. All right. Let's say we only have a breaker here order block here, and then of course old high, and then an inefficiency. All right. And if this is a point of fair value, right, or this is the first array, then it's not so much of how many pulses, because you don't know how the price action is going to occur. All you can do is keep thinking stops to inefficiency, stops to imbalance, right? Rebalance the range. And you know that price is reaching up into that array. All right. So you can't, there is no way to know, right? However, what you do know is that price is pushing to that array. And once it arrives at that array, you're then looking for that smart money reversal, changes in order flow, changes in the state of delivery. Right. Okay, cool. How do you determine the discount and fair value area? Usually we use the high, low of the swing point. For your examples, I can't see. All right. Can you ask that question just so I make sure that I
You've
give
answered
you?
it already. I asked at the beginning.
Oh, okay.
Thank
Okay. Cool. Cool.
thank
All
you.
right.
Thank you.
Great question. Yes, sir. Great questions. There we go. Okay. Cool. All right. So last call, right? As you guys can see, it is literally open door policy for asking questions. That's what I prefer. If I say anything that may contradict your current level of understanding, right? Challenge that question, right? Or challenge whatever I'm saying to make sure that we arrive at the correct understanding. Okay. Don't just leave it on the table because I say it, right? Challenge me, make sure that what I say aligns with your understanding. And obviously, look, we can see a swing low, forming right here. Okay. So if we don't have any questions, we'll close the call out. I'll send you guys. I'll try to get you guys this quiz within the next couple of days. It'll be a quiz where you just go through and kind of answer questions based on this lecture, right? And then in terms of homework, what I want you guys to do for homework, and I'll have a homework session in the chat or section in the chat for you guys to upload, and me and the team will provide revisions and things of that sort, and then you all can learn from each other's homework. But what I want you guys to do is go to a chart, and I want you to focus on delivery. I want you to find those dealing ranges. Like for me right now, right? I can look at any chart and I can see the delivery right here. I can see that that's a bullish dealing range, right? Price took out sell stops, took out buy stops, came back, rebalanced that range 3, and look, boom, 4 takes out 2. Okay. Now, what I'm seeing, like low key, what I'm seeing is 1, 2, right? We kind of traded up into the range, 3, right, into the inefficiency, and then here, right? So the draw is probably going to become what? 1. So what I want you guys to do is go to a chart and force yourself. It's not going to make sense on the very first sitting. All right. So don't get frustrated. Every time you challenge yourself, right, it forces the mind to expand, right, and create new mental pathways. Now you have to trust that. So go to the chart. I want you to look for that delivery. Look for dealing ranges. Find 10 examples of bullish dealing ranges, 10 bearish dealing ranges. Okay. When you find those examples, right, you're going to mark 1, 2, 3, right, 4. You're going to place on the chart, engineer, neutralize, distribute, rebalance, redistribute, right? Get yourself in the habit of that repetition, of seeing price through delivery, not just candles, delivery. All right. And also get some examples of, I'll send this in the chat. I know I'm speaking a lot. Get some examples of scenarios where it's just compressed, where you can see the delivery just through a few candles. Right? Understanding that this delivery is the same as that delivery, right? It's just flipped. Okay. So challenge yourself to do that. I promise you it will pay off. Does anybody have any questions about what I'm asking in terms of homework? All right. All right, cool. Well, thank you guys for joining. I thank you guys for your questions and your attention. And we will keep building on this Don't forget you have a midweek Q&A session with Coach Vision, right? So basically jump right on that homework so that you can see exactly what you're still missing, and then show up to that Q&A session and literally fire away. All right. So thank you guys, and I will see you. I'll see you next Sunday. Well, actually throughout the chat, but all right.